Welcome to a video that I like to call the deep dive video, and I feel each week I need to explain this. I use the term deep dive in a bit of a different context. Every week I do a number of videos. I do a video each day. I do a weekly video. Also once a week I do an intermarket analysis video. Then the last video that I do over the weekend, I look through all of the daily charts and I pick out those charts that maybe I didn't use at all, or maybe just one or two times throughout the course of the last week. I try to put together the videos each day that are actually using charts that tell us information as it's actually happening. So I add and take away different charts throughout the week. There are times when we're really focused on a chart or a certain set of charts. There's other times when we don't see those charts for quite a while. And this video is to try to take those charts that we don't see as often, put them together. There's also some charts that only apply to this particular video, because taken together with the daily videos and the weekly videos and all the other videos that I do, the idea is to give you a comprehensive overview of what's happening specifically with the S&P 500. This is being prepared for Monday, November 27th. The first chart that we look at, I only use in this video. We have a chart of the VIX. This measures sentiment. When the VIX is high, it's time to buy. When the VIX is low, it's time to go. Well, usually we use static numbers with the VIX. 12 to the downside. When we're 12 or below, that shows there's really no fear in the market. And 20 and above to the upside, that's suggesting that there's a lot of fear in the market. But the VIX doesn't always stick to that nice static range. It's more dynamic. So what I do is I place a 50-period exponential moving average over top of the VIX, and then I change the VIX invisible on this chart. So we only see the moving average. You can see that over a period of time, there is a more established range that has been developed. Sometimes we're higher, sometimes we're lower. After the COVID plunge, we went higher. Now we're potentially dropping down to a lower range. We don't make any decisions based on this. This is more just for information. It's nice to know, what is the VIX doing overall? Another area that we look at is a VIX to S&P 500 correlation. Lately, the sentiment charts that we're using, they're doing a pretty good job. Sometimes they're not really helping us, but this chart might help us. It's the correlation between the VIX and the S&P 500. When we have a real high reading here, we go above the dashed line, that typically means the market is getting kind of nervous. We may not be seeing that in the VIX, but we will see it on this chart sometimes. And so we just keep an eye on this. Now we're getting a very low reading right now, which is why I haven't really been including this chart. There's really no reason to. It's not telling us anything. Then we keep an eye on the MOVE index, which measures the volatility of bonds. And then in the middle area, we watch the VIX, which measures the volatility of stocks. And then down below, I have a very simple study. We have the S&P 500 in red, and then the spread between the VIX, and I subtract the MOVE index to kind of give us an idea of what is the overall direction. But what I pay most attention to is at the bottom. I look at the correlation. Is the MOVE index and the VIX, are they moving in the same general direction, or are they going in opposite directions? And after going in opposite directions for a while and being more neutral, they're starting to get a stronger relationship now as this line is going up. The higher we get with this reading, the more correlated these two charts are with each other. Then we also look at the skew index, and I did show this in a video recently because we started to spike up into this red area. Since then, we've dropped down, so I stopped using that chart. And I explained this as this was happening. The market was expecting something kind of big. In this case, the market went up after that. There's other times when we spike and come down where the market topped out and started to come down. Other times where it just continued. Well, here you could also make a case that the latest reading was a continuation because we had already been going up before that. Then we look at where are we in relation to the all-time high, which was set in January of 2022. We are down 5.38%. Over on the left is the all-time high. Over on the right is the close at Friday's session. Then we look at a thing called technical alerts. And because of the slower week, I was able to include all of the alerts for this past week. These are put out by stockcharts.com. We read them from the bottom up. When something positive happens, it's blue or green, depending on what you see. When it's negative, it turns red. And the first signal that we saw was at the bottom, and then the very last signal that was triggered in Friday's session, we see here where gold crossed above 2,000. That's seen as a positive thing. And we can look throughout this list just to see different sectors, different markets, what's happening, just to get an idea. Is the overall atmosphere more positive or is it negative? When we're blue or green like this, that's positive. When we see a lot of red, that's more negative. Then we have another thing that stockcharts.com does, and they have this objective scoring method for charts. You can do this with individual stocks. I use this with indexes. There's 5 main indexes that we look at. Of course, the focal point of everything that I do and teach and all the strategies that I do and teach, that is involved with the S&P 500. But we also look at the Dow, we look at the NASDAQ 100, we look at the mid caps, and we look at the small caps. And then we can rank those indexes on a technical analysis score. We're not using emotion. We're just looking at some rules that were defined here that come up with this value. Coming in first place again are the QQQs, which is the NASDAQ 100. It's dropping down just a little bit, but it's still at 95.2. That's really close to 100 naturally. And so this is the best looking chart, and it has been looking good for a while. In second place is the SPY, which is the ETF for the S&P 500. It's coming in at 86.9, and that's still fairly positive. In third place are the diamonds, and that's the Dow Jones Industrial Average coming in at 80.3. And lately we've been seeing some improvement with this score. In fourth place are the mid caps, which were really showing some weakness earlier. Now they're starting to show some strength, and they're coming in at 56.2. And then in last place are the small caps, as represented by the IWM. That's the ETF for the Russell 2000. We got down in actually below 20. We were into the teens here, and so we're starting to see some improvement. We want to keep an eye on the small caps, because if they really start to go up, that could help the rest of the market to go higher. And it looks like it might be beginning to happen, and then they kind of fall back. And so we just keep watching this day after day. Some short-term charts that we can look at. First of all, we have a short-term rainbow. All these pretty little lines that you see on here, they go from 10 periods up to 50 periods. And of course, I changed the colors. And we're meant to look at this chart in total, just to kind of get a big picture look at what is trend doing overall. When we hit the skids back in August and September and really started to go down, well, this rainbow started to go down. And now we've been breaking out above that rainbow. And the longer we stay above it, the more we'll see these lines turn back up and things will turn more positive. If we start to see a real decline, then these lines will get jumbled up again. We also look at a double and triple exponential moving average. The first one that we look at is based on 20 periods. And that's the green line and the blue line. And when the green line is above the blue line, that tends to move a little faster, so that's even more positive. Then we look at a regular 20-period moving average study, where I take an exponential moving average. That's more weighted, closer to current values, and a simple moving average, which treats all 20 prices the same. And we're well above that, so I haven't been including this chart in our analysis. And the blue line is above the red line because it moves a little bit faster, and that's also suggesting in the short term that we are still positive. Some intermediate term charts. Here's another rainbow that is short term. That's interesting. It should be from 50 periods up to 100 periods, and just take my word for it, it is showing some improvement here. Then we look at the NYSE McClellan oscillator. Now, the one that I focus on is the S&P 500 McClellan oscillator. That's just for the S&P. Where the NYSE McClellan oscillator, that's more broad-based. So if this is starting to show some improvement, that's on a broader scale. And we are going up. We're above zero and advancing, and we're not getting extreme. Where with the S&P McClellan oscillator, we're getting above this upper line here, so we're starting to look a little extreme positive. But this is just showing that the broader market is turning more positive. Then we look at the percent B indicator. Bollinger Bands are very popular with a lot of investors, and I use them too. Well, as we're moving around here, sometimes we close above or below the upper or lower Bollinger Band, and that's what the percent B indicator measures. And we did get kind of an extreme reading here earlier in November, and then we've been coming down. Now, we can also look at this as what is the general bias of this line. It's above the midpoint, even though it has been coming back down slightly. So it's positive overall and not giving us an extreme reading. Then we look at the anchored moving average going back to the all-time high, and we're well above that. I was showing this chart a few weeks back as we were really headed lower, and we actually broke below it briefly, but then we've been able to bounce back above it. We look at the Connors RSI, which is another momentum oscillator. It's also based on a scale, so we can look at this as an extreme positive or negative or overbought or oversold indicator. We did get a couple of extreme positive readings, and when these happen, I use this in the daily video. Since that time, we've been dropping back down. It's pretty spastic overall. This thing moves all over the place, but to get extreme readings is something that doesn't happen all that often. Then we look at a 50-period double and triple exponential moving average, and this is turning more positive. This is intermediate term, and we're seeing the red line crossing above the blue line, and that's turning things slightly more positive. And we have a regular 50-period moving average study. The blue line's going above the red line, and prices are well above it, so I haven't been including this chart, and it's turning more positive in the intermediate term. We have a 100-period moving average study. We were right in between the exponential and simple moving average for quite a while. We were able to break out above that, and we're getting kind of far away, so I haven't been including this chart. Then we want to know, are we above or below the 200-day simple moving average? When we're green and going up, we're above it. That's longer-term positive. We look at standard deviation, and this doesn't necessarily measure, it's how fast either an index or a stock is moving. And we were getting pretty speedy up here for a while. When this goes up, it's based on 10 periods. That means that it's moving pretty quick. Well, since that time, we've been really dropping back, and we're still above the moving average, but this has been declining lately. Then we compare the S&P 100 to the S&P 500. We're looking for any kind of divergences or convergences. Right now, they're pretty much converging with each other. They're pretty much going in the same direction. And so we're not seeing anything that's really alarming us right now. Then we look at just some approximate measurements that I took. We have the all-time high, and then the low set in October 2022, and then the big run-up that we saw, and then the retracement that we've seen since July 31st. We came down to this level, and now we've been bouncing back up again just to get some ideas of what are we looking at in percentage moves. Then we have a 50-day cycle, and I don't know if this is helpful or not. It seems like it's been okay over the last year or so. There might be a shorter cycle or a longer cycle that's more advantageous. I started using this, and sometimes it seems to help. Other times it doesn't seem to do very much. The next cycle will actually start on January 1st, which the market's closed on that day. So it'll actually be January 2nd. Then here's the 100 to 500 again, in case you didn't pick that up the first time. Then some long-term charts. Here's the long-term rainbow going from 50 periods up to 250 periods. And we're breaking out above all of the lines in the rainbow. And this is starting to turn back up. Even when we were going down, yeah, the top areas started to roll over a bit, but the integrity of this rainbow longer term didn't really lose its composure. Then we look at the special K, and this is a long-term oscillator where we were watching this really closely. Just to give you an idea, right when we started to hit trouble back in 2022, this crossed over negative and stayed negative. We tried to cross over last spring in April, and then we saw a pullback after that. But then as the market really took off in the early part of the summer, this turned positive. Then when things got a little hairy in September and October and August, we started to drop negative. Now we're crossing back over positive. Just to let you know, the weekly version of this chart is still negative. We're still below the red line and declining. Then we look at a weekly chart of the S&P and compare it with the weekly chart of the German DAX index, and they're having a fairly strong relationship right now. Doesn't necessarily mean they're going up or down. It just means they're doing the same thing at the same time, just to give us a little heads up on things. Then we look at the U.S. 10-year treasury yield, and we subtract the German 10-year yield, and that gives us a line up here, and it's a positive answer for right now because we're above this midpoint. And then what's interesting about this is we can look at the US dollar index and see that there's a pretty strong correlated relationship between the two. Now lately we've been seeing this coming down as interest rates have been falling, and the dollar's been under some pressure lately. The correlation between the two is pretty strong, and this has been giving some support to stocks. So when this is going up, that may be pressuring stocks. When either one of these lines are going up or down, that can either, if it's going down, sometimes that will give support to the market. Then some support and resistance areas. I can't really use these because for a lot of these charts, we're in what I call no man's land. This isn't support or resistance. This is a thing called a mass index, and it tries to measure reversals. If we're really moving in one direction and this signal is triggered when we get a real high reading here, and then it turns and goes the other way, it thinks the market is also going to reverse at that point. Sometimes this is a useful indicator. Other times it's useless. Here is a trend line study going from the June 2022 low to the October 2022 low. Then I put a trend line here. Then I drew a parallel line going from the all-time high. And last spring, we were hitting this area and bouncing back a few times before we broke through it. Since we broke through it, I stopped showing this chart. I was starting to show it again as we were dropping down, but we never got back down to the trend line. And since we've been going back up again, I stopped showing the chart. Then here's a quadrant where I just measure from the COVID low to the all-time high and separate them into 25% chunks. We're kind of in no man's land right now. So this chart hasn't been all that helpful. Also, when we look at our shorter term fib chart, we're also in no man's land because we're breaking out above the 100% retracement. A longer term fib chart, we're also in no man's land currently. And a longer term fib chart, we're also in no man's land. So it's like, okay, we can just watch this, that it doesn't really tell us all that much. I look at these every day, and if they do start to tell us something, then I put them in the videos. Then this is an indicator that I developed a long time ago based on a strategy where I just take a 20-period simple moving average of the open, high, low, close. That creates kind of a little small rainbow or a mini rainbow here. And we're seeing that price is well above all of these moving averages, and the rainbow itself is going up. So we are positive. Since it's based on 20 periods, that's more of a short-term indicator. Then we look at the Ichimoku cloud. A lot of people really rely on these. Really, all they are a set of moving averages that are then shifted forward. And we can use this as potential support or resistance. I was showing this chart every day when we were trying to break through the red cloud. Well, since we broke above that, I stopped showing this chart. One thing that we can take away from this that is positive, when it's green, that's positive. When it's red, that's negative. We were seeing red for a while because that was when we were going down over the summer months. But now it's starting to turn back to green. So that's looking a little more longer term positive. Then we look at the fib levels for the NASDAQ 100. We're also in no man's land between the 100% retracement and the 61.8% retracement. Then we're keeping an eye on this, the financial sector. It's been showing some improvement. It's actually seeing a golden cross now. Well, we're wondering if we start to fall, there's this red line here that may end up acting as support. Since we're far away from that, I haven't been showing the chart. Then we look at the VIXN, which is the volatility of the NASDAQ 100. And because of all this erroneous data in the middle area, I tend to follow the line chart, but I really focus on the VIX most of all. And we look at a weekly chart of the QQQs, which is the NASDAQ 100, and we're looking pretty good here. We're starting to break out against these previous highs. So this chart is showing some improvement. We also have an anchored moving average going back to the all-time high, and we're well above that. And even when we were declining throughout the later summer months, we never really came down close to this moving average. We look at the bank ETF, which is finally starting to break above its 200-day moving average. That's the red line. We're still in a longer-term downtrend. Banks really took a dump last March and just fell off a cliff and have been going sideways, but we are seeing a little bit of improvement lately, but they're still in a negative trend. Then we compare the regional banking ETF with the financial sector, showing that the regional banks continue to underperform the financial sector. We look at a ratio between the QQQs, which is the NASDAQ 100, and the diamonds, which is the Dow Jones Industrial Average, and that relationship's falling off just a little bit right now. Usually it tends to stay pretty strong. We want to keep an eye on this chart. We also look at TIPS, which are Treasury inflation protected securities. They will adjust according to interest rates. Well, when the folks in the market are really nervous about interest rates going up, folks get into TIPS. When they think interest rates are done being raised and now they can lock in longer term maturities, then we see this ratio actually going down. And that's what we're seeing. I have another chart here. This looks further out where we're seeing this going up. So that's a little bit of a discrepancy. But lately, over the last month or so, this ratio has started to come back down. So in the first one, we look at TIPS to 3 to 7 year bonds, and that's declining. Then we look at TIPS to 7 to 10 year bonds, and that had been going up because there was some inflation concerns, and that was putting pressure on stocks. Lately, the economic reports that have been coming out have been typically weaker than expected. We saw an exception to that this past week with the jobless claims, but this has been declining. And so that's turning the interest rate environment more positive. What folks do is they get into longer term maturities. They want to lock in a higher yield because they feel that maybe that's as high as it's going to go. And so they want to lock that in for 7, 8, 9, 10 years. Then we look at home construction, which is a very heavily interest rate influenced area of the market. If interest rates were going to be going up, we would not be seeing the ratio between the home construction and the bond ETF going up like it is. Now, it was really screaming higher, and then we saw some problems with interest rates, so it started to come back down, but now it's starting to go back up. This is showing broader-based improvement. Then we look at discretionary and the staples, but instead of looking at some of the other ETFs and indexes that we look at, this is an equal weight ETF, both for discretionary and staples. Now, discretionary has been a better performer in 2023 until we got into the later summer months. We're starting to see a bit of a comeback here, but we're still in a downtrend. Staples did well in 2022. They've been under a lot of pressure, especially lately in 2023, and they're really underperforming. Then down on the bottom, we take a ratio between the two, and in a more solid environment, we want to see this ratio going up, and it's actually starting to decline after it had been chopping sideways, even though it's still in a longer-term uptrend. We want discretionary and small caps to do better. If both of them started to perform better, we would see a more positive market environment. Some rate of change charts, these are just for information. We look at the close on Friday and then go back 250 trading periods ago, and we're just kind of chopping around right now. Here's a longer term look at that same chart. Then we keep an eye on bonds. This is the 3 to 7 year bond, and then we do a ratio between it and the S&P 500. When this is going down the way it has been, that means that bonds are underperforming stocks. Then we look at the TLT, which is the long-term bond ETF, and we compare it to the S&P 500. And longer term, based on 50 periods, they have a pretty strong correlated relationship. They may both be going up or down, but they tend to go in the same direction at the same time. And in the short term, they also, based on 10 periods, also have a tendency to go in the same direction. On the bottom are just two different ways of measuring the spread between the TLT and the S&P. Then we look at the ratio between the Qs and the TLT, and they have a pretty strong correlated relationship of going in the same direction with each other. Then we look at the yield curve, and the important ones are the 10 to the 2 year and the 10 to the 3 month. They have been showing some improvement. They're starting to go back down now, but they're still inverted. Where we see the 30 to the 5 and the 10 to the 5, it kind of floats above zero and then floats down below it. So they're a little more volatile, and they're not necessarily as important. We watch the two main ones that I watch are the top two yield curves. Then an update of some possible positive scenarios. This is what we look at when the market's really going down and it looks like we could be forming a bottom, and that can be very helpful, but we can also use these indicators at other times. This is the percent of S&P 500 stocks that are above their 200-day simple moving average. As this is going up and it crosses above 50, that's turning more positive. Now, sometimes we can use this like an oscillator. When it gets extreme positive or extreme negative, we're not there right now. But the fact that this is going up is suggesting on a longer term basis that things are looking better. Then we look at a 50-period moving average of the S&P, and this is showing improvement. We also look at a 50-period exponential moving average of the small caps, and that's showing some improvement. And then we look at the mid cap. There should be a mid cap one in here. It's looking a little better. So thank you. I hope you found this helpful. I know that was I made some mistakes with a few of the slides, but please feel free to check out the daily videos, the weekly videos, the intermarket analysis video. I hope you have a really great weekend, and I will talk to you in the next video.